Welcome back to The Wealth Effect. I'm your host, Green Moon, and today we're talking about a topic that's glamorized and marketed as a dream. But for most, it turns into a nightmare. Today, we're talking about day trading. Day trading might make you think of fast paced decision making, financial freedom, and the thrill of beating the market, all from a laptop. But behind the glamour is a harsh reality. The vast majority of day traders lose money. We'll talk about the psychology, the statistics, and by the end of the episode, you'll walk away with an answer. Let's fill your pocket. The fantasy of day trading. Imagine it. You wake up, make a few trades, and by lunch, you've made more money than most people do in a week. Day trading appeals to people because of autonomy. No boss, no 9 to 5 schedule, scalability, the potential for large returns, the technology, saying that it's easy to access these trading platforms. Media and influencers, YouTube and TikTok are flooded with success stories. The appeal is often sold via social media, but most influencers earn more from selling courses than they actually do from trading. That's the dream. That gets sold, and it's powerful. It appeals to something deep in us, the gambler, the rebel, the freedom seeker. But like all dreams sold online, it comes with fine print. Understanding day trading. Day trading refers to buying and selling financial instruments such as stocks, futures, cryptos, and options within the same trading day, often closing out positions before the market closes, sometimes a few times a day or more depending on the person. The goal? To profit off the small price movements each day. And only basic tools are needed to day trade, such as a decently fast computer or honestly a phone, high-speed internet, and some type of trading platform such as Robinhood, Webull, or honestly most banks offer this service as well. Now here's the statistical reality. Now here's the data behind day trading. Because while social media shows wins, the stats tell the truth. In one US-based study conducted by North American Securities Administration Association, it found that 80% of day traders quit within the first 2 years. And it gets worse. Only 1% of day traders are consistently profitable after fees, commission, and slippage. A similar study done by Brad Barber and Terrence Oden, professors at the University of California, analyzed trading behavior from large brokerage databases. They found that the top 10% of active traders earned positive abnormal returns, but the bottom 90% lost money, with net losses increasing the more frequently they traded. And here's the thing, the more confident a trader was, the worse they performed. Why? Because day trading preys on the illusion of control. You're up $500 today. Great. But what happens when volatility spikes tomorrow and you're down $2,000? The reason 80% of traders quit isn't just financial, it's emotional. Day trading is a high stakes, high stress, attention draining task. It demands constant monitoring, intense decision making, and emotional neutrality that very few people possess, especially in environments driven by dopamine and social pressure. Many traders chase losses. They over leverage. They believe that the next big win will make it all worth it. But statistically speaking, only a fraction of 1% beat the market consistently. The rest, they become cautionary tales and not success stories. Even if you're good, even if you're lucky, day trading is mentally exhausting. Every tick of the market can cost you. Every second you're watching the charts, your heart rate spikes. Day trading isn't just about strategy, it's about psychology. Stress and burnout are affected by every tick you see your capital drop. Beginners often overestimate their edge. New traders often chase losses, leading to even more losses. Let's talk about the gurus, the ones selling you the freedom lifestyles, the Lamborghinis, the private jets, the daily profit screenshots. But if you look closer, most of them don't make their money from trading. They make their money from selling courses about trading. There's a word for that. It's called grift. What they're selling is not a path to freedom. It's a loop of false hope. Success stories usually follow a survivorship bias. You rarely hear from traders that blew up their account, those who quit only after 6 months or even a week after starting, people who got into deep debt from trying to fund their investment accounts. Comparing day trading to long-term investing, the S&P 500 has averaged 7 to 10% returns annually over the last 50 years. It's compounded, it's passive, and it's boring, but it works. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient, and day traders are the impatient." And there are also regulatory and tax considerations when day trading that most people might overlook. Some must maintain a $25,000 minimum balance on their account if they execute 4 trades a day within a 5-day period. And when it comes to tax treatment, short-term gains are treated as regular income and can be taxed up to 27%. There is no capital gains discount, unlike long-term investing, where the max tax rate would be 20%. Frequent trading also complicates your tax filings and can incur more costs when filing your taxes at the end of the year. And sure, some people succeed. You've got people who turned a few $1,000s into millions, but traded 10 hours a day, tracked every pattern, and treated it like a business. And now, most of their money comes from teaching and selling courses, not day trading. On the other side, there are thousands of stories on YouTube, Reddit, and forums of people losing their life savings, houses, and maxing out credit cards, all to chase a fantasy. And it all comes at an opportunity cost. If you would have spent those 6 to 8 hours instead of day trading, you put it towards learning a new skill, starting a business, building something more sustainable, where would you be in 5 years? It's not just about the money, it's about time, health, and peace of mind. Wealth is more than just dollars. It's options, it's time, it's freedom, it's energy for the people and passions that matter to you the most. In the past, day trading was reserved for those professionals in suits, in skyscrapers, in banks, phones ringing off. But now anyone with a Wi-Fi connection and a smartphone can become a trader. The market is more accessible than ever before, but that's why it's also more dangerous. Why? Because the opponent has changed. You're no longer trading against people. You're trading against machines. High frequency trading, HFT, high frequency trading is the game behind the game. It's not talked about in YouTube thumbnails or finance TikToks, but it quietly dominates the market. These are trades executed in microseconds. Run by hedge funds and institutions, these systems do not rely on intuition or chart patterns. They rely on math, physics, and proximity to servers. If you're late by a millisecond, you're out. These firms spend millions to gain a millisecond edge by buying physical space closer to exchanges to reduce latency. And let that sink in. While you're waiting for a candlestick pattern to confirm, there's an algorithm that had already made thousands in trading. That's the retail disadvantage. Even if you're smart, ambitious, and maybe read a few books or taken some courses, you're still at a structural disadvantage. And you need to know that before risking your life savings, because what you're up against is execution speed, because retail orders are seconds behind institutional orders that are milliseconds ahead of you. Retail traders also rely on public data feeds. Institutions pay priority for low latency feeds that show up before the market even gets to see it. There's also spread costs. High frequency trades often profit by scalping the spread, the difference between the bid and ask price, making it more expensive for retail traders to get in and out of positions. And perhaps most importantly, you're making decisions based on emotions, while the machines aren't. You can't outspeed the machines. You can't out-analyze any algorithm that reads the market in depth in nanoseconds. You cannot beat the system that was never built for you to win, but you can change your approach. For instance, if you're trying to outtrade machines, build a strategy that machines don't care about, like long-term investing, asset allocation, business building, real estate acquisition. These are strategies that have generated wealth for such a long time that no trading cycle would ever disrupt. So, is day trading worth it? For 95% of people? No. For beginners? Absolutely not. But here's a nuance. If you treat it like a profession with years of education, discipline, and capital, and you have the psychology of a stoic monk, maybe. But don't confuse trading for freedom, and definitely don't confuse it for wealth building. Real wealth comes from consistent action, long-term thinking, and minimizing mistakes, not hitting home runs. At the Wealth Effect, we're not about crushing dreams, but for 95 to 97% of listeners, it's a losing position. It promises autonomy, but often delivers stress, losses, and disillusion. While a rare few achieve profitability, their success is often tied to rigorous discipline, experience, and data, not institutions or luck. If your goal is long-term wealth, peace of mind, financial freedom, consider alternatives like long-term investing, building businesses, and acquiring skills that help you build the wealth you want. The cost of day trading is not just financial. It's time, energy, and emotional stability. For most people, that's too steep of a price. So is day trading worth it? For almost everyone, no. For a few, maybe, but only if they're treating it like a profession and not a game. Thank you for listening. Until next time.